All right, ready to dive in. Today, it's Security Analysis
The Value Investing Bible,
by Benjamin Graham and David Dodd. You know, Warren Buffett's favorite.
the book that shaped generations of investors, Buffett included. He credits it for his success.
And we're looking at the sixth edition. Even though it's from 2008, those principles still relevant.
Oh, absolutely.
Think of it as like a treasure map to those undervalued securities just waiting.
The heart of value investing, right?
Mm-hmm.
Seeing that gap between a company's real worth and the market price.
So how do we figure out that intrinsic value, especially when the market's all over the place?
Graham and Dodd have a great analogy for this. Think of the market, short term, it's a voting machine. Emotions, headlines, all that. But long term, it's a weighing machine. True worth shows up eventually.
Okay, so tune out the noise, focus on the fundamental.
Yeah, the real weight of the company. Assets, earnings, future potential.
Security analysis gives us the tools for that.
Like they did with Northern Pipeline back in the 30s. They figured its intrinsic value was around $95 a share, but it was trading way lower, like $65.
Wow, spotting those bargains. But let's talk bonds. Their approach to fixed income is, well, interesting. Depression basis?
Who knew?
Kind of eyebrow-raising,
Right,
right?
that's-
Especially now, some investors have done well with those higher yield bonds, even though they're riskier.
You got to consider the context. They were writing after the Great Depression. Even supposedly safe bets went bad.
Right.
So they wanted to instill caution, be ready for the worst case.
Even though things have been pretty stable for a while now, they'd still say approach bonds with that depression mindset.
Their argument is that margin of safety, it's always key, no matter what the market's doing. They say pick bonds like a depression's about to hit. Make sure they can handle anything. No chasing yield if it sacrifices safety.
Makes you think, like building a house extra strong just in case. But those high-yield bonds, some people made good money, right?
True, but higher returns always mean higher risk. Graham and Dodd would say, for most investors, especially those looking long-term, it's not worth it.
Okay, so bonds. Approach with caution. Got it. Now, those common stocks, lots of portfolios are heavy on them. Are they really as risky as people think?
That's a myth they wanted to bust. They argue that common stocks, when you analyze them rigorously, like bonds, they can be solid and rewarding.
So no throwing darts at a board.
No. Deep dive into the financials, the company's position, its long-term outlook.
And they were wary of just relying on projections, those rosy pictures of future earnings.
Right. Those can inflate a company's perceived value. They thought a company's past, its track record, that's a much better indicator of the future.
So look beyond the hype, dig into history, see how they generate profits, and whether they can weather the storms.
Exactly. And that historical analysis got to include dividends. Some investors love those steady payouts. Others want companies to reinvest, aim for growth.
That's a good question. Dividends versus reinvestment. What's better?
The age-old debate. Graham and Dodd offer insights into both sides. They highlight the appeal of consistent dividends, especially if you're after reliable income.
But reinvesting, that can power some serious growth, right? Especially for companies with room to expand, new products, maybe acquisitions.
And they stress, got to understand why a company chooses its dividend policy. Is it about maximizing return through payouts? Or is it about fueling growth by reinvesting?
Okay, seeing the depth here. It's not about rigid rules. It's about really understanding the company, financial, strategy, how they generate value long term. Let's get into those financials, the heart of it all. What should we really be scrutinizing?
Big takeaway from security analysis is be careful with those earnings figures. Even back then, those numbers could be manipulated.
Really? Back then?
Oh, yeah. They warned investors to look beyond the surface, understand the quality of those earnings, like National Cash Register. Early 1900s, they got caught inflating earnings. How? Including sales of stuff that hadn't even shipped yet.
Wow. So numbers don't always tell the whole story. How do we avoid those tricks? See the company's real earning power.
They offer some great techniques. Watch out for non-recurring items.
Yeah.
Those can really distort the picture.
What are those? How do they mess things up?
Say a company sells a big asset, like real estate. They report a huge one-time gain. Makes the earnings look amazing, but it's not from their normal operation.
So gotta separate those one-offs from the core business. If you're judging a bakery, you look at the bread, not the occasional catering order.
Perfect analogy. They also say pay attention to depreciation and depletion charges.
Depreciation, okay, that's wear and tear on assets, machinery, buildings. But depletion charges, what are those?
Think of it like using up natural resources. A mining company extracting coal, that resource gets smaller. Depletion charges reflect that.
So even though they seem like little things, these charges can really impact a company's earnings, especially if they rely on those assets or resources.
Exactly. And Graham and Dodd give you ways to analyze those charges, make sure they reflect the true cost.
This is fascinating stuff. I'm seeing how understanding this can help make smarter choices.
That's the goal, empowering investors to think critically, challenge those reported numbers, get a true sense of the company's financial health.
And speaking of critical thinking, let's talk about those relationships, stockholders and management. Why is that so important for us to get?
Security analysis challenges this idea that management always acts in the shareholders' best interest. They saw that sometimes those interests clash.
Wait, management might not put shareholder value first. Isn't that their job?
It should be, but they give examples where decisions, sometimes intentionally, sometimes not, actually hurt shareholder value.
How? Like what?
White Motor Company in the 20s. Management kept paying dividends even though the company was weakening. Kept shareholders happy short term, but depleted resources. Hurt their ability to grow or handle downturns.
Like giving a patient painkillers but not treating the disease. Makes things worse in the long run.
Exactly. Security analysis helps you spot those conflicts of interest and evaluate what management's doing. They actually encourage shareholder activism, hold management accountable.
So we can't just be passive. We got to be informed and engaged.
Absolutely. We're the owners in the end. It's about recognizing that, as shareholders, we're the real owners. We have a right, a responsibility to make sure management's acting in our best interest.
Right. Got to be vigilant, informed, engaged. So we've talked financials, earnings, watching management. But how do we actually use all this to make decisions?
That's where the art and science of value investing come in. Security analysis gives you the framework to find those undervalued securities, but it also stresses discipline, patience, thinking long-term.
No chasing quick profits, trying to time the market, or jumping on the bandwagon.
Nope. It's building a portfolio of solid companies, trading for less than they're worth. Then you wait. Let the market catch up.
And they talk about different types of securities, bonds, preferred stock, common stock, helping you understand the risks and the potential rewards with each.
Exactly.
So let's get into some specifics. What really stood out to you about their bond investing ideas, especially with that margin of safety, preparing for tough times, all that?
One thing that's really striking is how much they emphasize scrutinizing those, those investment-grade bonds,
Yeah.
the ones that seem safe. Remember, back then, even highly rated bonds could default. Big losses for investors.
So don't be fooled by the ratings. Got to look deeper.
Exactly. Analyze the issuer's financial strength. Can they generate cash flow to cover the interest payments? Repay the principal when it matures? And you got to understand where that bond sits in the capital structure.
Capital structure. Explain that one to me. Sounds a bit technical.
Think of it like a pyramid. At the top, you've got those with the first claim if things go bad. Usually secured creditors, banks with mortgages, then unsecured creditors, bondholders, and at the bottom, common stockholders.
So if a company goes bankrupt, the higher up you are, the better. The bottom might get nothing.
Exactly. Graham and Dodd say, got to know where your bond sits in that pyramid, how much cushion's above it, how likely is it to get paid even if things go south.
So even with those safe investment-grade bonds, got to be careful. Make sure there's that margin of safety.
Absolutely. And they talk about protective covenants that are often built into bond agreements.
Okay, break that down for me. Protective covenants. What are they and why should I care?
Think of them as like rules. They restrict what the company can do to protect the bondholders. Like a covenant might limit how much more debt they can take on, or prevent them from paying out huge dividends, or selling off important assets.
So it's like a contract with some safeguards. Make sure the company doesn't do anything reckless that could hurt their ability to pay us back.
Exactly. They act as safeguards. Additional layer of protection, Graham and Dodd say, carefully review those covenants. Understand the restrictions, make sure they're strong enough.
Now, what about preferred stock? Those are kind of in-betweeners, right? Between bonds and common stock. Fixed dividend, but also ownership like common stock.
Yeah, they can be interesting. Balance of income and potential growth, but unique risks too.
Stable income, but with a chance to ride the wave if the company does well.
Right. But Graham and Dodd stress, got to understand those terms and conditions. Can be tricky. Especially dividend rights. What happens to your claim in a liquidation? And those convertibility features.
Convertibility, explain that.
Some preferred stock lets you convert it into common stock under certain conditions. Attractive if you think the company's going to take off.
So trade in your preferred shares for a piece of the action. Could be good if things go up.
Exactly. But remember, convertibility has risks too. If the company's stock tanks, that conversion option might be worthless.
Not a sure thing. Potential reward, but that conversion might not work out.
Right. Graham and Dodd say weigh those factors carefully. Understand those conversion terms and how they might impact you before you jump in.
All right, makes sense. Now, common stocks, the big one. Lots of excitement and anxiety around them. We talked about analyzing real earning power, not just the reported numbers. What other insights do they offer when it comes to common stocks?
Well, one of the most valuable things they highlight is the importance of understanding the business itself, its position in the market, and its long-term prospects. They warn against relying too much on those quantitative measures, like earnings multiples or price-to-book ratios. Got to go deeper. Qualitatively assess the company, its strengths, its weaknesses, its growth potential.
Be a business analyst, not just a number cruncher. Figure out what makes them tick, what sets them apart, where they're going.
Precisely. They give you a framework to analyze these things. Look at management quality,
Right.
brand reputation, product innovation, how efficient are their operations, and what's going on in the overall industry.
And they remind us, yeah, those stockholder management relationships, be critical of who's in charge, make sure their actions are good for us, the shareholders.
They have some great examples of how those relationships can go bad. Pennsylvania Railroad, early 1900s. Valuable real estate assets, but controlled by financiers who were more interested in their own profits than in doing what's best for the shareholders. Graham and Dodd exposed that. Showed the need for shareholder activism, holding management accountable.
Be an engaged owner, not just along for the ride. Understand those dynamics, spot those conflicts of interest, and be ready to speak up. Make sure our interests are protected.
Exactly. And they also get into this interesting and sometimes controversial area, technical analysis.
Wait, technical analysis, like chart reading, trend lines, all those indicators people use to try and predict where the stock's going. Why would Graham and Dodd, who are all about fundamentals, even talk about that?
It is interesting that they include it, especially since they were pretty skeptical of relying on past price movements to predict the future. They did acknowledge that technical analysis could have some limited use, maybe for spotting short-term trading opportunities, especially if you're good at reading charts and those indicators.
But they wouldn't say it's reliable for making long-term investment decisions. They were convinced that focusing on intrinsic value based on those fundamentals, that's what leads to success over time.
Right. They even compare chart reading to playing roulette. They say that, yeah, some systems might help you limit losses in the short run, but they don't guarantee consistent profits.
Like those flashing lights and spinning wheels at the casino. Might be fun, but it's a gamble, not how you build wealth.
Exactly. Security analysis reminds us, real investment success, it comes from understanding that intrinsic value, not trying to outsmart the market based on past prices.
So we've covered analyzing financials, evaluating management, understanding different types of securities. What are some of the big pitfalls investors should look out for? Red flags that say, stay away.
One of the biggest is too much debt on the balance sheet. Remember, they lived through the Depression. Companies with too much leverage, they were the first to go under when things got bad.
Like a heavy anchor dragging a ship down. Hard to stay afloat in rough seas.
Exactly. They also warn against companies with weak earnings quality, where the profits are coming from one-time gains or accounting tricks instead of solid operations.
Got to see where those profits are really coming from. Make sure it's the core business, not financial engineering, that's creating the illusion of success.
Right. And be careful with companies that have really complex or opaque business models. Hard to figure out what's driving the profits and what the risks are.
Like wandering through a maze without a map? Might find your way out, but probably going to get lost.
That's a good way to put it. Security analysis emphasizes clarity, transparency. Focus on companies with understandable businesses and straightforward financials, where you can easily grasp the numbers and verify them.
Now, let's shift gears a bit. Corporate structures. Sometimes those can get pretty complicated. Lots of subsidiaries, interconnected entities. Why should we care about all that?
This is where their insights into corporate pyramiding are important. They warn about those complex structures that can hide the true financial health of the underlying businesses and create conflicts of interest.
Help me picture corporate pyramiding. Sounds a bit like a game of Jenga. One wrong move, and the whole thing crashes.
Think of it like those Russian nesting dolls. You've got a parent company at the top, controlling all these subsidiaries, each with its own assets, liabilities, performance, and those subsidiaries might own parts of even more companies. A tangled web.
Like trying to untangle a big ball of yarn, hard to see the big picture.
Exactly. And while these structures might have some tax advantages or legal benefits, they make it really hard to assess the real risks and rewards of the whole thing.
So buyer beware. Got to be really careful with those complex structures. Make sure we're not investing in a house of cards.
Exactly. Be cautious with those opaque structures. They push for transparency. Really understand those underlying businesses before you invest.
Makes sense. Now, mergers and acquisitions. Always exciting and sometimes a bit nerve-wracking for investors. What do Graham and Dodd have to say about navigating that world, especially how those deals might impact our investments?
Their perspective on mergers and acquisitions is interesting. They emphasize understanding the motivations behind the deal. What are the implications for both companies involved? They warn against just assuming that all mergers are good. Got to critically assess the terms and whether it really adds value for the long-term investor.
Don't just get caught up in the hype. Synergies, growth potential, all that. Understand the strategy, the price being paid. Is it truly creating value for us?
Yeah. They point out the potential problems with mergers that are driven by, empire building or speculation rather than good business sense. Scrutinize the financials, the price paid, how the deal is structured, any potential dilution of ownership for existing shareholders.
Like evaluating a marriage. Look beyond the initial excitement. Assess that long-term compatibility, financial stability, shared goals. Is it a good match or a recipe for disaster?
Exactly. And they also stress considering those cultural and operational challenges. When you integrate two different companies, that's often underestimated and can lead to problems down the road.
It's not just about the numbers. It's the human element. Potential clashes in culture, management styles, how they do business, like blending two families, sometimes smooth, sometimes, well, there are some growing pains.
Security analysis helps you navigate those complexities. Take a holistic view of mergers and acquisitions. Don't just get swept up in the hype.
Okay, so we've covered a lot. Analyzing statements, evaluating management, understanding different securities and structures. But what are some of those universal principles of value investing? The ones that go beyond specific industries or market conditions, those timeless truths that everyone should remember.
One of the most important and enduring is the idea of a margin of safety. Buying something for significantly less than its estimated intrinsic value. Remember, they came of age during huge market swings, economic uncertainty. They believed that safety cushion was crucial to protect you from those market swings and those unexpected problems.
Like having shock absorbers on your car, smooth out the ride, right?
Exactly. And that margin of safety can come from different places. A low purchase price compared to the company's assets, earnings, or dividends, or a really deep understanding of the company's competitive advantages and whether they can last.
So it's not just finding a cheap stock. It's about understanding why it's undervalued. Is it based on solid fundamentals, realistic view of the future?
Right. And that brings us to another crucial principle, independent thinking. They constantly emphasize the need to develop your own judgment. Do your own research. Challenge the conventional wisdom. Be willing to be different, even when it feels uncomfortable or goes against what everyone else is doing.
Be a contrarian. Think for yourself. Don't get caught up in the herd mentality.
Exactly. Be skeptical. Question assumptions. Dig into the data. Come to your own conclusions. Don't just blindly follow the so-called experts or what everyone else is saying.
Like having your own internal compass, guiding your decisions with logic and reason, not letting emotions take over.
Exactly. That independent thinking is how you find those opportunities the market misses, those hidden gems that everyone else overlooks.
Now, patience. Easier said than done, right? Why is it so important in value investing?
Patience is key, especially for value investors. Remember, they believe that prices can be all over the place in the short term, driven by emotion, speculation. But eventually, they'll reflect the company's real worth over the long term.
So you have to ride out those market storms, don't panic sell when things drop, and don't chase those hot stocks that everyone's going crazy for.
Exactly. Focus on the long game. Trust that a well-researched, undervalued investment will pay off eventually, even if it takes time.
It's like planting a seed and waiting for it to grow. Can't rush the process, but with time and care, you get the rewards.
Perfect analogy. And that patience applies to the research process too. Be thorough. Take your time to understand the company, its financials, its future, before you invest.
Be the marathon runner, not the sprinter. Make those thoughtful decisions. Don't rush in without understanding the risks and rewards.
Right. Patience and discipline are what separate successful value investors from those who get caught in the short-term frenzy, chasing those quick profits that often disappear just as fast.
Now, managing risk. That can make or break an investor. We talked about margin of safety, that buffer against the unexpected. What other insights do they offer for mitigating risk, protecting our capital?
One of their key recommendations is diversification. Spreading your investments across different industries, companies, asset classes reduces the impact if one investment goes bad.
Don't put all your eggs in one basket. If one falls, you don't lose everything.
Exactly. And diversification seems simple, but people forget it. They get too concentrated in a few favorites.
Like a bridge with lots of supports. Even if one weakens, the whole structure can still hold.
That's a good way to think about it. Diversification helps you handle those market storms, make sure your portfolio is resilient.
Now, we all make mistakes, right? Even experienced investors. What do they say about learning from those missteps and becoming better investors because of them?
They actually encourage you to see those mistakes as opportunities to learn and grow. Analyze what went wrong, what factors contributed to the loss. Use those lessons to improve your process so you don't repeat the same mistakes.
Like that Thomas Edison quote, right? I haven't failed. I've just found 10,000 ways that won't work.
Exactly. Every mistake, even if it hurts, can be a valuable lesson if you're open-minded and willing to look critically at what happened.
Like a pilot analyzing a near miss. Figure out what went wrong, adjust the procedures to prevent it next time.
Exactly. That constant learning and adaptation is how investors refine their skills, make better choices, achieve long-term success.
Now, how about those easy money opportunities? The ones that promise quick profits, no effort. How do they say we should deal with those tempting schemes that are usually too good to be true?
Their advice is so relevant today with all those scams and get-rich-quick schemes online and everywhere else. They say be careful of investments promising those super high returns with little or no risk. If it sounds too good to be true, it probably is.
Be skeptical. Question those promises. Remember, there's no free lunch when it comes to investing.
Right. Be wary of those high-pressure sales tactics, emotional appeals. True success comes from research, analysis, and a realistic understanding of risk.
Be a smart investor, not an easy target. Those shortcuts often lead to dead ends, or worse.
And they warn about investments that are too complex or opaque, where it's hard to understand the assets or the strategy.
Like signing a contract without reading it. Could agree to something you don't understand, the consequences could be bad.
Security analysis emphasizes transparency. You got to clearly understand the investment before you put any money in. Ask questions. Demand clear explanations. Walk away if it doesn't feel right or you don't get it.
Okay, good advice. Now let's talk about something that can be tough for all of us. Managing emotions. Emotions are so powerful when it comes to investing. How do we keep them from clouding our judgment and leading us to make bad decisions?
Their insights into the psychology of investing are really helpful here. They knew that emotions, like fear and greed, can make us do irrational things. Buy high when we're excited, sell low when we panic.
And it's like our emotions are driving the car. If we don't control them, they can crash us.
That's a good one. Develop discipline. Stick to your plan even when things get rough or your emotions start taking over.
Stay cool. Make decisions based on logic, not feelings.
Right. Think long-term. Focus on that underlying value, not those short-term price swings that can trigger those emotional responses.
The market's a roller coaster. Ups and downs are going to happen. But if you focus on the destination, those bumps are less scary.
Exactly. That long-term view helps you avoid those knee-jerk reactions that lead to buying high and selling low.
Now, there are so many different investment strategies and philosophies out there. How do we navigate all that and find a style that fits us, our goals, risk tolerance, who we are as investors?
This is where their emphasis on finding an approach that resonates with you personally is so important. Your temperament, your beliefs. They believe there's no one right way to invest. Everyone needs to find a style that they're comfortable with, that matches their financial goals.
Like choosing a pair of shoes, right? What fits one person might not work for another. Got to find the right fit.
Right. Consider your time horizon, how much risk you can handle, how much you know about investing before you jump into any specific strategy.
So self-awareness, knowing your strengths, your weaknesses, what you're comfortable with, like finding a dance partner who moves to the same beat.
Exactly. And they warn against just following the latest trends or chasing those hot stocks. Real success comes from building a sound, consistent approach that fits you.
Okay, we've explored a lot of the key principles here. Analyzing financials, evaluating management, understanding red flags. But if you had to pick the most important takeaways, those nuggets of wisdom, what would they be?
One of the most crucial is to think of a stock as owning a piece of a business, not just a piece of paper or trade. Think like a business owner. Evaluate the quality of the company. Can it generate sustainable profits over the long term?
Look beyond the ticker symbols and charts. Understand the real operations, the products, the services, the people. Like owning a bakery and being invested in the quality of their bread, how they run things, how happy the customers are.
Exactly. That mindset helps you make better decisions. You focus on the long-term health of the company, not those short-term market ups and downs that can be distracting.
Now, those financial statements, they can be intimidating, even for experienced investors. What's their advice for making sense of the numbers, understanding the story behind them?
They say learn the basics of financial accounting. Know how to read a balance sheet, income statement, cash flow statement. They explain those key ratios and metrics so you can assess profitability, liquidity, solvency.
Like learning a new language. Business finance. Might seem tough at first, but with practice, you can unlock those insights.
And they caution against taking those numbers at face value. Dig deeper. Look for those red flags, those accounting tricks that can distort the real picture.
Be a detective. Examine the statements for clues, anything suspicious that needs more investigation, like admiring a painting, then looking closer to see the brushstrokes, the details that make up the whole picture.
That's a great way to put it. That critical eye is essential to separate the companies with solid financials from those that might be hiding something.
There's always pressure to keep up with the latest trends. The hot stocks, the gurus promising easy riches. How do we tune out that noise and focus on what matters?
They always emphasized focusing on intrinsic value. The company's real worth, based on its assets, its earnings power, its long-term potential. They believed market prices can be irrational in the short term, driven by emotions, speculation, but eventually the market catches up.
So stick to your plan. Ignore the sirens trying to tempt you into making impulsive decisions based on fear or greed instead of analysis.
Exactly. Think long-term. Be patient. Wait for those undervalued opportunities. Don't chase the hot stocks that are probably overpriced.
Like a gardener. You cultivate your plot, pick the right seeds, take care of the soil, wait for the plants to grow. You can't control the weather or make them grow faster. But with work and patience, you get those rewards.
That patience and discipline, that's what separates the winners from the losers in the market.
Now, market downturns, recessions, those can really shake things up. What wisdom do they offer for getting through those tough times, coming out stronger?
Their view on downturns is insightful, especially considering they went through the Depression. They thought those times of panic, uncertainty, often create the best opportunities for value investors. Because fear and pessimism can push prices way below what a company's really worth.
Like that saying, right? Buy when there's blood in the streets, even if it's your own. Have the courage to invest when everyone else is panicking. See those downturns as opportunities, not disasters.
Exactly. Think long-term. Remember, those tough times usually don't last forever. Well-managed companies with solid fundamentals, they recover. They thrive.
Like a ship in a storm. Gets tossed around, it's rough. But if the ship's good and the captain knows what they're doing, you'll reach your destination.
And having that confidence in the fundamentals helps you weather those storms. Come out the other side with your portfolio intact, maybe even better than before.
So we've covered a lot today. Those timeless principles of value investing from security analysis. But if we were to sum it up, what are those essential takeaways? The things every investor should remember?
Well, one of the most important is to see investing as a long-term game. Build a portfolio of high-quality companies, trading for less than they're worth. Be patient, be disciplined, and keep learning. Those are key to navigating the market and achieving lasting financial success.
It's not about getting rich quick. It's about building wealth steadily through research, analysis, and holding those undervalued companies.
Exactly. And understand your own investment personality.
Yeah.
How much risk you can handle. What are your goals? Find an investing style that suits you.
Know yourself as an investor, your strengths, your weaknesses, what you're comfortable with. Find an approach that fits your philosophy, that you can stick with through good times and bad.
Right. And finally, they remind us that investing is a journey, not a destination. Be curious, keep learning, and keep improving.
Embrace the process, the challenges, the rewards. Keep learning, keep refining your skills. Enjoy the ride.
Security analysis gives you that roadmap, a guide to become a smarter, more thoughtful, and more empowered investor.
Yeah, like a road trip across the country. Plan your route, you pack your bags, but you know there'll be detours. It's all part of the adventure.
I like that. And security analysis, it's like a journey too. Through different investments, those safe bonds, those more volatile stocks, they make you look past the labels, really understand what they are.
Their bond analysis, especially that depression basis idea, that was eye-opening. Makes you think about those worst-case scenarios, even when everything seems fine.
Well, they were waiting after the Depression, right? When even those supposedly safe bonds, they collapsed. They wanted investors to be ready, pick bonds like another crash was coming.
Like a stress test for your investments. Can they handle a major shock?
Exactly. They give you a way to evaluate real safety. Look beyond the ratings, the interest rates, see how strong the issuer is financially. Can they meet their obligations, even when things are tough?
Yeah.
And are there those protective covenants, those extra safety measures?
And they talk about preferred stock, too. Those hybrids, part bond, part common stock. They could be good for income and growth, but they come with their own risks.
Yeah, these stress understanding those terms and conditions can get complicated. Dividend rights, what happens in a liquidation, and those conversion features.
Those conversion features, those are interesting. Could swap your preferred shares for common stock, maybe get in on the growth. But like they said, if the company's stock tanks, that conversion's useless.
Right, you got to weigh the pros and cons. Really look at those conversion terms, how they could affect you before you make a move.
Now, common stocks, those are in a lot of portfolios. We talked about their focus on analyzing a company's true earning power, not just the numbers they report. What else stood out to you about their common stock analysis?
Well, they really stress understanding the business itself, its competitive edge, its long-term potential. Don't just rely on those numbers like price to earnings ratios or whatever. Go deeper. Assess the company's strengths, weaknesses, growth potential.
Like a detective, right? Gathering clues. Their history, management products, the industry, build that complete picture.
Yeah, they give you a framework for that. Analyze management quality, the brand's reputation, innovation, operational efficiency, and the big picture trends in the industry.
Numbers are important, but they're not everything. You got to understand the people behind those numbers, the ones making the decisions.
And their analysis of those stockholder management relationships, that's really insightful. Shows how conflicts of interest can come up. Shareholders need to be watchful. They give real examples of companies where management's actions weren't in the best interest of the shareholders. Investors need to hold them accountable, stand up for their rights.
So we got to be active owners, not just passive. Spot those red flags, be ready to speak up, make sure our voices are heard.
Absolutely. And they encourage us to be curious, keep learning. The market's always changing, so a good investor is always learning.
That's a great point. Security analysis, it's more than a textbook. It's a guide to navigating the investment world, a toolkit for making smart decisions, and a reminder that investing, with all its ups and downs, it's a journey.
It is. And as Graham and Dodd said, the intelligent investor, they're a realist. They sell to optimists and buy from pessimists.
That's all for this deep dive into security analysis. Hope you got some good insights from it. Feel inspired to use those principles in your own investing.
Keep exploring, keep learning, and keep those investing lights shining bright.